Today, I'm going to share with you the no BS version of how I would grow a $10,000 account by selling options. In today's video, I'm going to share with you not only the strategy that I would use, but some of the realities about trading that you need to be aware of if you're trying to start with a smaller account around $10,000 and looking to really scale it up. And what it's going to take to size that up and start making a really good return for yourself. Not only today or this year, but for the long run. Remember, you're not always going to have a $10,000 account. So you want to be doing things that are going to work with that $50,000 and $100,000 and beyond account sizes. So let's get started with the first lesson here. What is the actual strategy that I would run? I would actually keep things really simple and focus on selling options on ETFs. Now, the reason I would focus on something really simple like just selling options on ETFs is because, first of all, we know that it works. We know that there is a variance risk premium embedded into the option premiums of ETFs. So we don't need to worry about if our fundamental principles are in check. We know that it should make money on average. And the reason we want to lean into that is because our account size is so small, we're probably going to want to be using a little bit of leverage. I'll talk a little bit more about that later, but that's why selling options on ETFs is in general good practice, even for small accounts. You might think to yourself, but Sean, that's kind of boring and I don't actually feel like I can generate a good return doing that. There's no point if I'm just going to make a couple $100 a year. And I understand when you say that. But realistically, we need to do things that actually work, regardless of how boring they are to begin with. What we're going to do from there is pack on a little bit of leverage to help up those returns, and I'll talk about why that's maybe worth considering with a $10,000 account size. So that's the strategy I would run. I would find a number of ETFs that have a positive variance risk premium, put together a little basket of those, and then I would be selling options on that basket and rolling them on, let's say, a monthly basis. Now, as for how I would find some trades, I am a little bit biased here because I literally built a platform that was meant for this, but I would actually use the Predicting Alpha terminal. It makes my life really simple. It does all the data analytics for me, and literally on the home page of the terminal is the starting basket that I would begin with. Let's take a look at it now. So here we are in the Predicting Alpha terminal, and right here is the basket that I would start with, these recommended trades. So I would pick 2 or 3 of these at least to begin with as I start up this portfolio. So maybe DIA, XLF, and USO, something like that. Any combination of these or even all of these. Now, the idea behind how these are picked, I've covered in a number of other videos about how the ETF premium strategy works. But generally speaking, you can see it here on the scanner. What we've done here is backtest whether the variance risk premium, meaning basically the profitability of selling options, has existed for all the ETFs in the US market. And then we also backtested if we can actually monetize it by considering things like slippage and transaction costs, the stuff that retail traders actually have to deal with when running these strategies. And then we ranked everything by their backtest return, and that's basically how we generated our list to say, hey, which ETFs have exhibited the variance risk premium and should be included in an option selling portfolio. Now, if you want to try this strategy out and leverage our tools, you could do so for free by clicking the link in the description below. You get a 7-day free trial, you get access to the other 4 strategies that we run, and trust me, if you're serious about option selling, you're going to love it. So you can go check it out for free in the description. Let's click on DIA here and just take a quick look at what we're seeing. So you can see here, this is basically the analysis for the variance risk premium. Every single day, we track it. We take the average of it. That's the number here. Then we back test it. Once again, every time the 30-day options are available, that's the return there. The combination of the two, as well as the IV percentile, that's basically what we're looking at to make our decision. Things with variance risk premium that we're able to capture that aren't just exploding right now, right? We're not trying to do this during COVID, for example. And that is literally the extent of the analysis that I would do to get this portfolio up and running. Remember, it's not about trying to predict what's going to happen tomorrow. The whole idea of option selling is that we want to be selling options on a basket of tickers that have exhibited the variance risk premium. If we can do that successfully and we can structure our trades well, we're going to be able to make some money. Theoretically, that should be all it takes to at least start generating a return. Now, of course, things such as execution and the fills you get, these obviously matter. But right now, we're just trying to get this $10,000 portfolio up and running and taking actions that have positive expected value, meaning actions that are actually supposed to make us money in the long run. And that's all it's going to take to get started. Put together a portfolio of ETFs that have positive variance risk premium and sell options across this basket. And that brings us to the next topic that we're going to cover, which is how do I actually structure these trades? So the trade structure that I would use on the $10,000 account is called a bull-put spread. A bull-put spread is where you sell an out-of-the-money put, and then you go even further out of the money and buy a put as a hedge. This structure allows you to capture a premium, which you get to keep as long as the stock price stays above the strike that you sold the option at. So if the stock goes up, great, you're going to make money. And even if the stock goes down a bit, you would still make money as long as it stays above that strike price. The reason the bull put spread is the best structure to trade when you're trading a $10,000 account is really for three reasons. The first reason is that the out-of-the-money puts, which is where we're really trying to be selling options, is where the greatest variance risk premium is. The reason the risk premium is so great there is because options are inherently a hedge product. And where are most people hedging? They're hedging their downside risk, and they're doing it by purchasing out-of-the-money puts. So we want to be selling where there's the most demand, and that's the out-of-the-money puts themselves. The second reason that this is a great structure to trade is because your risk is hedged. One of the biggest fears people have about selling puts naked is that they have this huge tail risk if things really get bad. But by going even further out of the money and buying another put there, we're capping that downside risk. And one thing just to be aware of there is we're not trying to create a good risk-reward trade. We're going really far out of the money, buying a put out there because it's meant to hedge away our disaster risk. And that's why we can still generate a return with this strategy, is because we still do hold a significant amount of risk, probably like a 1 to 10 risk reward on each of our positions. But we are not going to take that 50x loser or whatever that could really take us out of the game. So we hedge away that risk. We still hold a good amount, so it makes sense why we're getting paid, and that allows us to have a structure that really works for us in this strategy. The third reason this structure makes sense for a $10,000 account is that it's really hands-off. You don't need to be delta hedging this position. You don't need to be worrying about any sort of position management that would come with, let's say, a short straddle or a short strangle. If things remain calm, stocks usually go up, and so you're going to make money on your position. And if things get really volatile, stocks are usually going down, which means there's a risk you'll lose money on the position. And this is actually the nature of the trade. This is the nature of selling options. When things get really volatile, you're often supposed to lose money. That is okay. There is no strategy that you don't lose money sometimes in. It's about understanding when you're supposed to lose money and structuring your trades such that in those times you lose money and in the other times you make money. And that's exactly what this bull put is giving us for the lowest amount of trade management required. Let's hop back over to the computer for a second, and I'll show you what this structure looks like using an example of a trade I have on right now on SPY. All right, so I made this little spreadsheet to just give you some numbers here and talk about the position. So the ticker was SPY, and when I placed the trade a couple days ago, the ticker was trading at a price of $604. Now, the action that I did was obviously this bull put spread, which we'll talk about here. I sold a 582 strike put for about $3.85, and then I purchased a 565 strike put for $2.16. The way you can think about this trade is I sold a Delta 20 put, and then I purchased a Delta 10 put. That's the easy way to sort of do the math to figure out where you should be selling. Obviously, the exact numbers, it actually doesn't matter too much. You can do what you're more comfortable with. So keep it simple. Sell the Delta 20, buy the Delta 10 for your first trade, just to get things started for you. Coming back over to the computer here, by selling the put at the 582 strike for $3.85 and buying the put at the 565 strike for $2.16, we create a bull put spread, which I collect a premium of $1.69 for. Now let's talk about what the risk reward of this trade is. My break-even price for this trade is equivalent to the strike that I sold at minus the premium I collected. So as long as the stock stays above $580.31, I'm going to make money on this trade. As a percentage move, that's almost a 4% move. So basically, I'm covered for a 4% move to the downside on SPY. Now, if we do see the stock price move below 580, we are going to start losing money on this position. And where we've capped our risk is at about a 6.5% move. So is this 2.5% move window on SPY right now, we're in a situation where we're losing some money. And that's the way that this trade is structured. If the S&P 500 doesn't move down more than 4% in the next 25 to 30 days or so, we're going to make money on this trade. And if it does move down more than that, we're going to start losing money, but our risk is capped at a 6.5% down move. So we don't have that risk if, let's say, there's a COVID type situation, stock moves down 12%, that's hedged away. Even in a situation like that, our worst case scenario is whatever loss comes at that 6.5% move or cut off at the Delta 10 puts, right? The ones that we purchased. Coming back over to the computer for a second, looking at our profit potential and our risk potential, it's about 1 to 10. And I think this is a ratio that really makes sense for this type of trade. Remember, we are short volatility, meaning that we are holding risk. If we don't hold any risk, there is no reason for us to get paid. The reason I like this strategy so much is because I understand why I'm making money. I'm holding downside risk on behalf of others who are willing to pay to hedge away that risk. Imagine I didn't hold that risk and thought for some reason that people should still be paying me. Like, this is not a charity. People aren't giving me money for free. They know they're paying a premium and they're willing to do it because they just don't want that risk on their book. That's cool. I totally get it. And the compensation is worth holding that risk over the long run. So a 1 to 10 risk reward here, right? Things go well, we make $170 or so. Things go wrong, max risk, right? If we see that 6.5% or greater move in a 30-day window on the S&P, our max risk is $1,700. So to recap what I would do with a $10,000 account so far, I would be selling options on ETFs in particular because we know exactly why we should be making money doing it. The way that I would go about finding these trades is using the Predicting Alpha terminal to price the ones that have the highest variance risk premium right now. I would pick a basket of those, even the ones that are just on the homepage to get started, and I would use a bull put spread to sell out of the money puts on each of these tickers, hedged with an even further out of the money put. I would put together a basket of this, and what I want to talk to you now is a little bit about what to expect with an account like this and how to manage a strategy like this. So the first thing that I want to share with you is that we have to be realistic. If we think that this strategy is going to turn our $10,000 account into $100,000 or even $50,000 in the next 12 months, we are probably kidding ourselves. And that's just the reality of trading. So the first thing we have to realize is that it is possible to make huge amounts of money running a strategy like this, but it takes money to make money as a trader. With a $10,000 account, the goal should be to generate a positive return. And once we can generate a positive return on our $10,000, we can start contributing to that account to grow the account much quicker than we could by just letting it compound without any contributions. And then as we get the account up to that $50,000 to $100,000 mark, all of a sudden we're going to see things really start to pick up and we're going to start to see returns that are extremely meaningful for the long run for us individually. Now, with that being said, I'm not sitting here saying that you should be totally optimized on how much margin you use, things like that, because in the end of the day, it is a $10,000 account. If this is a sum of money that is going to make or break your living situation, you should not be doing this at all, right? Like you should be putting that money into like just the S&P 500 and leaving it there. You shouldn't be taking risks with capital like that. So I'm assuming this is capital that you're willing to learn how to trade with and you're looking to build something a little bit bigger, a little more sustainable for the long run. And so if that's the case, I would pack on a little bit more heat, right? Rather than having maybe one of these spreads on or something, I would maybe have a couple of them on, right? Maybe you have one on SPY, you have one on DIA, you have one on USO, and your margin utilization might be a little higher than you would be comfortable with at, like, say, a $100,000 account, right? Maybe you're collecting, $400 of premium a month, $500 of premium a month here, which is a huge sum relative to a $10,000 account. Because if things do go really poorly, if the market crashes, you're going to take a big drawdown when you're collecting this much premium, right? Remember, you might take like a 40% drawdown, something like that. But on a $10,000 account, maybe it's worth stepping on the gas a little bit to try and bump up those returns. In the end of the day, we're getting paid for holding risk. And with a smaller account, maybe it's worth holding that risk at a little bit higher of a degree because, hey, look, it's a smaller account. We got to take some risks that we wouldn't do with, let's say, $1 million if we're trying to really get somewhere with this account. At the same time that I'm doing that, I would still be contributing to the account. Once I've got a hang for how this bull put spread works and how to put together a basket of these trades, I would be doing that, $500 a month contribution, right? Think about this. If you do $500 a month added to the account, you just did 60% on your $10,000 in a year. And nothing is going to beat that. That is what's going to drive the growth of this account in these really early stages. I hope you can appreciate, me trying to be honest with you guys here and share with you the reality of what it takes to grow an account like this. You got to pack on a little bit of leverage. You got to be contributing to the account, and you got to be realistic about the returns that you can expect from a strategy like this. Now, to end off on a high note, on a good note here, the strategies work. It's strategies like this that are used at all levels of option trading. And so by getting started with something like this, you're setting yourself up for a really long-term success in the world of trading. So if you have questions about this strategy, please leave a comment below. I will respond to you. I'll give you my honest feedback. I'm happy to answer any questions. I'm open to any critiques as well. If you think this strategy could be adjusted in some way, please let me know. Let's chat about it. And of course, if you're really serious about option trading, the link in the description is your best friend. I'm going to give you a free trial with PA. There's also my free option selling masterclass there. No sign up required, no email required. It's a Google sheet that I put together. All of these resources are there for you because we are building the best community possible for option traders, for option sellers in particular. And I would love to see you there if you're someone who loves this game as much as we do. All right, everyone. Thanks so much for your time, and we'll see you in the next video.